Welcome for those who have joined or will join shortly. And thank you for joining our webinar on how to identify property hotspot before they boom. So before we proceed further, few housekeeping rule. This webinar is being recorded. A link to the recording will be shared with all participants after the session. To avoid background noise, please keep yourself on mute while the speaker is presenting. This helps maintain audio quality for everyone. We'll have a dedicated Q&A session at the end. Please type your question into the chat box as they come up. We'll address as many as possible during the Q&A. If time runs short, feel free to contact us afterward. We'll make sure your questions are answered. So let's start. Over to you, Rohit.
Okay, so see, as we are doing this topic today, so how to identify the property hotspots before they boom, right? So it's no rocket science. It can definitely be learned, and we'll deep dive into that, right? So it is going to be two of us as a presenter, and I'll start with my introduction, and then I'll hand it over to Deepak. So a bit of about my background. So I basically came to the country in 2017 after a decade of experience in IT in India. So driven by goals of building a better lifestyle here. So until 2022, I built a portfolio of 8 properties while working at my 9 to 5 in Combank, and then there was a car crash which was a turning point. And after that, I started evaluating my options because I wanted to do something meaningful. And while I was working at Combank, I have bought 7 properties in 18 months. That gave me a very good understanding of how to buy it correctly. And then during this journey, I also helped a few friends of mine. So, and that got me interested in real estate property sourcing, helping people. But then that wasn't my career. But then my career which was paying my bills, was not fulfilling. And this car crash was the turning point, which basically made me switch into this. So, InvestTrade was founded in late 2022, and we have since then, we would have helped close to 300 clients by now. We would have bought 300 plus properties now, but I think our client count has just crossed 200 people. So my first property was bought in 2019. My 12th purchase was done a month ago. And my total portfolio is valued around 12.5 to $13 million, and with more than $5 million in equity. So I've been featured on a few news articles. I've been featured on news.com.au, realestate.com.au. If you Google my name, you'll probably find the links there. Then I've appeared on several podcasts like Smart Property Investments, Peasant Property, The Intrepid Investor, Geared for Growth, and I'm doing another podcast tomorrow and another one next week. So over to you, Deepak, for your
Yeah,
introduction.
thanks, Roy. Thanks for the intro. So I've been working with InvestTrade since I think since the InvestTrade have been founded. So before that, I was in India. I've moved to this country in 2016 after spending 10 years in telecom industry back in India. Initially, I took some IT related job. After a few years, I realized I wasn't satisfied with the work I was doing, seeking more fulfilling career. So I made the decision transition to the real estate. And since joined InvestTrade, I have assisted close to I think 50 to 40 clients, and the transaction I've been part of from start to the end, around 80 to 90 transaction. That's it for me, Rohit. Over to you.
Okay, perfect. So let's get into so this is just a disclaimer.
Okay. So before we proceed further, before we get into the nitty-gritty of the her data metrics and everything, I would like to read the disclaimer. The information provided in this webinar is for general informational purpose only and does not constitute financial, legal, tax, accounting, or property advice. It has not taken into account your individual's objective or personal circumstances. Before acting on any content, we strongly recommend seeking advice from a qualified and independent professional relevant to your situation. Yeah, I think let's start with.
Okay, perfect. So now let's come to the $1 million question, right? Why invest in hotspots, right? So everyone is talking about that we need to be finding hotspots to invest, and but why, right? And the main reason for everyone is faster capital growth, right? The why behind faster capital growth could be different. Some people might be chasing their faster capital growth because they are probably very close to their retirement age, and they want as much money as they can make till the time they retire, right? Or in their retirement age, right? So that could be one of the drivers. But so for someone who is young, who's wanting to build a portfolio in their acquisition phase, they might be chasing again same faster capital growth, but their intention could be that they want to build the equity sooner and then use that as a deposit to buy their subsequent purchase, right? Because just relying on your savings is going to be the slowest way to come up with deposit. Your property can actually do it a lot faster if you have invested it in the correct markets. Yep. So I'll just move on to the next one. Yep. Okay. So three biggest mistakes that investors make, right? So the first mistake, which is very, very common, and I'm sure most of you would agree, right? So many people just chase the hype, just they chase the news, they chase people talking about it on all the social media channels, and they are just chasing the hype because they have seen it on the news. Then they want to invest there because they are more comfortable in investing in markets which is appearing in all the news channels. But the truth is, if it starts appearing on Google or news, you are already too late. The market as the market might have performed really, really well, and the news must be talking about that, right? So we'll discuss a few examples where we think like we have gone past their peaks. But yeah, chasing the hype is one of the biggest mistakes that people make, right? They are wanting to invest in markets where their friends have invested and have had significant gains, and now they are thinking that investing in the same markets where they had their friends have got significant gains, they would exactly replicate or they would have replicate those success stories, right? Which is very far from the truth. Another mistake that people make is that they ignore the market cycle timing. I'll be discussing a bit more in detail about this market cycle timing and the importance of that, but this is one of the biggest factors contributing to the capital growth. So market cycle timing always does the heavy lifting. So, but I'll cover in the subsequent slides when we get there. And then the third one is neglecting the on the ground due diligence. There are many people, including buyers agents today, who are buying in markets based on supply and demand fundamentals, which is great. Definitely, you need to be looking at the supply and demand fundamentals because practically it's impossible for you to be going across 15,000 suburbs across Australia, right? So you need to be narrowing down to a handful of suburbs using data metrics. But then it is equally important for you to be traveling on the ground and do the due diligence, which I'll again cover a lot more in depth in why you need to be doing that and what you need to be doing while you're on the ground. So avoiding these mistakes sets you apart from average investors. Yep. And then over to you for the poll, Maggie. So I'll do a poll here and let's understand what our people think. So the biggest challenge in investing, right? Which of you think is the hardest when investing? So is it finding the right locations, developing right investment strategy, knowing when to buy, and then understanding data metrics for demand and supply, or negotiating the deal and due diligence? Yeah, just provide your responses so we know like where you need the biggest help. Yep. We'll probably give it another couple of seconds. Yep. Let's end the poll here. I And this is very, very interesting because I'll be touching upon this exact. Okay, so most of us think like we have got 11 responses so far. And out of 11, is it 11? Yes, it
Yeah.
is. So out of 11, 8 think that finding the right location is the key, right? So we'll be discussing a bit on that as well in the subsequent slide. And I think that should be very, very helpful for you. Because where for you could be very different for where for me and where for others, right? Uh, Perfect. So let's move on. Okay, so market cycle timing, as I was discussing earlier, right? That is the key driver for growth. In real estate, typically you make money in two forms, right? Either the market does the heavy lifting for you, where based on market cycle timing, that market has not grown for maybe 10, 12, 15 years, and then the market has just been lagging a lot behind than the other markets, and the supply and demand fundamentals are growth, they're really great, right? So that could be a good market cycle timing, again, depending upon a lot of factors, which I'll discuss again. But market cycle timing does the heavy lifting, where you are not even required to lift a finger, and the cycle basically does its job. You might get 60, 70, 80, or more over 100% capital growth in a couple of years, just based on market cycle timing without spending a single cent on doing the uplift in the property, right? The other way the people make money in real estate is by doing the hard work, where they are finding something which needs a little bit of uplift, or they are basically securing a subdivision site where they can add value in some shape and form. It could be through the renovations or it could be through subdivisions, right? Or it could just be buying a land and then trying to build in a market where that building a house on a land could make you money, right? That is a hard path where you are too much actively engaged, not really ideal for people who are already too busy in their jobs and then managing their family and kids, right? But this is also a way for you to make money. But understand the you can actually do both, right? So like if you're targeting the markets where the market cycle timing is favorable, you can also buy something with a value add uplift where you are just increasing your uplift potential. But the biggest gains in history are always made through market cycle timing. So if you are just a local investor investing in a local market, you have to buy something with a value add potential, because whenever you are ready, that may not be the best time to invest in that local market. So the only way that you can actually add or make equity or add some value is through the uplift. But if you are borderless investor who can tap into any markets across Australia, you can actually find at any given point markets which are going to go really, really, or going to do really, really well in next 12 months, right? So heavy lifting is always done by market cycle timing. So without lifting a finger, you can actually make good money. So that is what I'm describing in the second paragraph. So you'll do really lot better in terms of capital growth by buying the worst asset in a market where the market cycle timing is favorable than buying the best asset in a market where it's not favorable, right? So very, very critical. Okay, so some of the examples of boomed market, right? And this is very strange but common today. Like whenever I'm talking to people, I work as a buyer's agent, right? So when I talk to so many people who are already very much conditioned that they need to be buying in Adelaide or Brisbane or Perth, because this is what they have been hearing lately on news for the last probably 2 years now, right? Not less. These are the markets which have really, really done well in the last 5 to 6 years. Adelaide has been going bonkers since 2020 and 2021. Brisbane started picking up in 2021, late 2021, and Perth has started picking up in 2022. And these markets have just shot 2.5 to 3 times again, depending upon suburbs and which market in particular we are talking. So if you get into these markets now, see, in 20 years' time, you will make money, right? But if you are talking in next 5 years, you want to be having equity uplift, then the likelihood of you making money in the next 5 years reduces drastically, because usually you wouldn't see a marketing doubling on something which has tripled in the last 5 years. Markets cannot go six times in 10-year period, right? It will never happen, at least here in Australia, right? So you need to be very, very careful. When a market really had a very good run, you might be entering a bit too late into their growth phase. Like the markets might have, and these are really, really good examples. Again, I'm not saying like holistically you should leave the complete city, but majority of the portions of these city have really, really gone past their boom. So understand, like in real estate, the growth is always like a sine curve, right? So even the tail end basically looks like a massive growth, right? It could be double digits for next 2 years. But after that, because the market has actually boomed quite a bit, the likelihood of it stagnating for a longer period of time is very, very high. And understand, people are now getting very confident in Brisbane when market has touched $800,000 to $1 million to $1.5 million, but they were never confident in investing in the same market at $400,000. And if you look at history of these, all these markets, right? Brisbane has been stagnant market between 2008 to 2020. You could have nearly paid like if you were sitting in 2020 and you were looking for last 10 years of growth, the CAGR, which is compounded annual growth rate, was less than 2%. But now if you look at for the last 10 years, it's touching double digits now. It has gone past 10%, right? It was earlier 9 point something, now have crossed even 10%. The reason is because these in the last 5 years, the market has actually gone 2.5, 3 times. So it has actually tweaked the compounded average growth rate, right? So Brisbane has got a very long history of stagnation. And now getting 3 times, it is likely to be getting into that phase soon. Like I cannot have a crystal ball where I can tell you when, but again, the majority of the boom has happened, right? Similarly with Perth, between 20, if you were picking something in 2021 in Perth, you are not even paying what people would have paid in 2014 and 2015. At 2015, it started correcting. So you were picking below the bottom of the market in the previous cycle, right? But now the market has gone 2.5 times again in many pockets, but somewhere it's two and somewhere it's slightly less. But even if it has doubled, like again, the likelihood of it doubling from today is not that high. So very, very important for you to look, like you need to be looking at the past performance. See, again, not looking at past. So past performance is not the only indicator. You need to be looking at various other parameters, but it by itself is also a very strong indicator. So you need to look at how high it has gone in the previous cycle. You also need to be checking what the previous cycles looked like and how, like, when did it boom, right? Did it boom in the last 3, 4 years, or has that boom happened and finished in the last 7, right? So you need to be looking at how far are you from the tail end of that boom. Also, how, like if it is stagnant, how long it is stagnant for. Say, for example, if a market has been stagnant for 10 years, the supply and demand fundamentals are very, very strong, then that could be a time that market might start booming. Again, you don't want to be investing again your money in a market which is stagnant, because what it basically means is that you don't know when it will rise, right? You want to invest in markets which are in their early phases of its growth. Ideally, a market which has been stagnant for a long time has got strong growth fundamentals and is still not, is not stagnant anymore and has started picking up, because that could be a sign where it is in early phases of its growth, and next 3 to 5 years, who knows, could be like this. But again, a few parameters you need to be looking at and not just this. So understanding where a property market is sitting in terms of cycle is very, very crucial for you if you want to do it right. And when I say right, like your intention is to go past 2 or 3 or 4 properties. Yep. Okay.
Rohit, we have a poll for market timing, market cycle timing. Can we run that, please?
Just give me a second. Oh, sorry.
Hmm.
So we have got a poll for market cycle timing. So let's do that. So market timing awareness, this is a question like, how confident are you in identifying the right markets? Like, yes, I track this closely. I have some idea, or not really sure. Okay, nice. Okay, so 70% think that, okay, 70% are really not sure.
Still
Oh,
going on.
yeah, still going on. Okay, so out of 12, one of them has been tracking it closely, which is great. 4 of them have got some idea, and 7 of them, they are really not sure. Perfect. No problems. I think this also sets some scene and gives me a lot more clarity on whom we are talking to, and I can tweak uh, my education around that. Perfect. So we have discussed this in depth. Now picking up regions for growth. So when you are picking up regions for growth, so when I'm referring to regions, I'm referring to cities now. So when you are picking up regions for growth, you need to be looking at the infrastructure spendings by federal and the state in the region, because the governments can move the region, because we are talking about like the government here in Australia can move the regions drastically. If they want a region to be growing, they can have infrastructure projects in the region, could be funded by the state government, by the LGAs, or could be a bigger projects funded by center or the federal, right? So when something is being funded on a large scale, they want the region to be growing. So initially it could just be growth in terms of the people who are doing those projects, but then their intention is to basically expand that region, and then it will be bringing a lot more population and driving growth. So infrastructure spending is very crucial for you need to be looking at, like what upgrades is the government doing, right? And then it can also look at what the volume of the spend is, because if there is a project which is only $5 million, it's insignificant for a region. But if we are talking hundreds of millions of dollars and billions of dollars, then it could be a very, very big uplift in the region, right? But again, not the only parameter, but one of the parameters that we need to be looking at. Second one, which is very, very crucial, economic diversity of the region. You need to understand what all economies are driving this particular region for growth, right? Because if there have been markets which look where that supply and demand looks very, very favorable, there is money being spent by the federal and the state, but then they don't have the economic diversity. They just have got a single industry supporting. It could just be resources sector. There could be multiple. multiple factories, right? But all of them might be belonging to the resources sector, right? It could be a red flag for you because unless you time your entry and especially exit correctly, these are not the right places for you to be investing in. We, as part of our service, which I'll discuss again later, which I think everyone who's wanting to do it themselves should be also doing, make sure that you're traveling to the regions and understanding how diverse that is. You can always Google find information through ABS and other portals, but understanding the local economy is very crucial. And then again, population growth. See, when we are talking about price growth, it is nothing but always a factor of demand and supply, right? Population growth is telling you the demand side. So if the population is growing, then yeah, that could actually be a good driver for growth. But you need to also understand why is this a transient population or is this a population growth for a longer period of time? Like, are the people really moving into that region and wanting to stay there and build their life there, or is it could just be a transient, which could be because of any resources? They are setting up their factories, but these are timed projects for 3 years and then they might go away. So if the population growth is transient, that could be again a red flag. But again, you don't look at any of these ones individually, you look at them holistically, right? So there is another poll that we want to run here. So maybe over to you for the poll. You're doing a poll here, Maggie? Okay, perfect. Okay, so this is about on the ground due diligence, right? Have you ever personally visited a suburb before buying there? Yes, always, sometimes, no, rely on online research and people's verdicts. Not yet, but planning to start doing that. Yep, which is great. You should always be inspecting, even if it is not in closer proximity. So I don't really know out of these 6 responses if they are only buying locally or they are buying interstate. But if they are buying locally, then yeah, it is easier. But if they're buying interstate, then if they're doing that, then that's awesome. You should continue to do that. And anyone who's just relying on online research and people's verdict, they are missing out big time. I'll discuss a bit more like how you should be going about it. But yeah, that is very crucial. Okay, not yet, but planning to start doing, which is great. Perfect. So we'll move on. How are we tracking with time? Okay, yeah.
Yeah, we are fine.
Okay, perfect. So we'll move on. Okay, so now we have discussed about picking the regions. Now we need to be discussing, we have selected down the right region now, and now we need to be looking at how to pick the best suburbs in the region. So usually most of these metrics that we look at are supply or demand data based metrics, right? But some of them are also referring to the socioeconomics. Yeah. So I can't be discussing just in the interest of time all the data metrics that we look at, but I'll just briefly explain on some of them and explain the importance of why they are important, right? So the first one is average days on market. Average days on market is an average metric of days on market calculated per suburb per month, right? So this is very crucial because this tells you the demand side. This tells you how hot the market is. You can do a temperature check by looking at days on market. An average days on market, you should be looking at point in time information of days, average days on market. But more importantly, you need to be looking at how is it trending. So say, for example, if I tell you average days on market is 54 for a suburb, as you can see on the screen, it may not provide you much meaningful information, right? But if I tell you an average days on market for this particular suburb today is 54, but 12 months ago it was 74, then that is clearly giving you an indication that the average days on market is declining, which means the demand is increasing, which means the prices are likely to rise. And the other way around, like if it is rising from 34 12 months ago to 54 today, then that means a decline in demand, which means the prices at best may stagnate, but it might also be subject to a little bit of softening, right? Okay, so the second one is stock on market. You need to be looking at what the stock levels are, and this is just a percentage of the total number of properties which are in the market today divided by the total number of properties in the suburb. So stock basically tells you in for the total number of properties how many percentage of properties are being sold or are being listed at the moment. The higher this number, it means there is more supply available. The lower this number, the favorable it is for investor. So again, as I said, like for all these metrics, you are not only wanting to look at point in time information, but trend. Trend is your friend here. Always follow the trend, because even if the stock on market today is looking promising to you, but if it is going upwards, then that could be a red flag, or you might need to basically look at that a bit more deeper to understand like how fast is it rising and how does it impact you, because your investments are all dependent on what you see here. Okay, this is again very crucial. You want to understand renters versus owner occupied percentage. So as an investor, you want to be investing in market where renter percentage is lower. Again, as I said earlier, like when you are looking at multiple data metrics, you can never find a unicorn suburb where all the 25, 30, 50 data metrics that you're looking at will stack up perfectly well. So there is no such unicorn suburb. So then you need to apply your conviction, or should have that experience, that sometimes you have to weigh some data metrics over the other, but this one is very crucial for you to understand. So renter to owner percentage, you want to be looking at suburbs where the renter percentage is lower, so that tomorrow when your property comes to the market for rental, it has got less competition for renting. And also when this is low, just give me a second, guys. And also when the rental percentage is lower, it basically means the owner occupancy is higher, which means the area is much more desirable, because more and more people are committing to mortgages to be living there, and they are not just renting. And also lower rental supply basically means that because the supply of the rental is low, but the desirability is high, the renter wants to move in, but they don't have enough option, which can also translate into rental growth. Yep. Are guys following? So if you can just send a thumbs up in the chat, we'll just pause for next 10-15 seconds and see if people are following it good enough. Let's see if people are enjoying the content. They are following it. Okay. No question mark in the chat. Sorry, no thumbs up in the chat, which basically, okay. Yeah, okay. Perfect. Thank you. Thanks a lot, guys. Yes, I can see it now coming through. Okay, that's good. Like in case you want me to slow down or have got any specific questions, you can just put in the chat. Yep. Okay, we'll move on. Vacancy rate, again, very crucial for you to understand where the vacancy rate is sitting at the moment and how is it trending. Anything under 3% is considered a healthy rental market. Anything under 2% is considered a tight rental market. Anything under 1% is considered a rental crisis. Many parts of the country have got rental crisis at the moment. Okay, so this search index very crucial, because this search, so whenever you are searching for a property on realestate.com.au or domain.com.au, that data gets captured and gets sold. So you can actually track how the search indexes for either buy or rental are tracking each month. And if your search for buy is increasing, it means there is upward pressure or increased interest in purchasing property in that particular suburb. And if it is declining, it means that the interest is actually decreasing. Interest basically means an increase in interest basically means increase in demand, which is likely to reflect in increase in prices, and vice versa. And you can actually do this even for rental. So you can understand like, is the rental demand increasing or is it decreasing? Another metric that we look at is the IRSAR score. This is the socioeconomic score of the suburb. So when we are talking about socioeconomics, the IRSAR score basically goes from 1 to 10. 1 being the lowest and 10 being the highest. And why it is very important for you to understand socioeconomics is because a suburb will never grow beyond the fundamentals of what locals can afford to pay there. So wherever you are living today, you would find in that city, you would find suburbs which are cheaper, but you would also find suburbs which are a lot more expensive, right? And when you start looking at the median incomes of the families and people living there, and the trades that they like the bar graph of the split in trades, you can actually clearly see why it is that way. Yep. So it's hard score again, understanding that is very important. So now getting to the inventory levels. Okay, so inventory level basically means what the stock levels look like, and this is not stock on percentage. It is inventory levels are always classified in number of months, and what it tells you is that based on the current stock on the market and the current days on market, if there is no other new listing that comes in, how long will it take for the complete stock to dry? Yeah. So 0.36 is very, very short. Like if there is no new listing coming in, like you would just finish all, there will not be availability of any property to purchase within 0.36 months. So this again tells you how the market is and the demand there. Again, building approval, this tells you the supply side of the equation. It tells you how the building approvals currently are, and understanding their trend is again very important. Like, is it trending up, trending down, or is it very flat? And then because this is telling you the supply side, because if the supply is flat and the demand is rising, it is again likely to cause you a price increase. Okay. So once suburbs are selected, the next step is on the ground due diligence. And this is very, very crucial. Just relying on the data metric without understanding what it means to be on the be living there is actually you're missing out on huge opportunity, or you could be investing in markets which are missing some very strong investing fundamentals, right? So we'll do a poll here, and before we move on. Okay, so how do you currently research property markets? Online portals, Google news articles, podcasts, chat GPT, professional data tools, buyers agents, or expert help. Nice. Okay, so most of the people are like, out of 12, 6 are looking at online portals, which is great. You may not be tapping into the off-market or pre-market opportunities, but that's still great as long as you are getting into the right markets. And Google news article podcast is okay, but may not be okay. So yeah, yeah, as I've discussed, like just be very cautious when you're doing that. ChatGPT again is referring to all the sources from these non-reliable. Again, ChatGPT could really be not the reliable. I would avoid, like I would rather go on Google and find it rather than relying on ChatGPT. Professional data tools, great, and then buyer's agent or expert help. Perfect. So we'll move on. Okay, so once the suburbs are selected, as I mentioned, on the ground due diligence is important. And what you need to be doing on the ground due diligence. Okay, so the first thing that you should be doing is, and we do it for every new market that we get into. So there's a lot of pre-work that goes into uh, selecting a market for our clients. So this is exactly what we do. So we need to be traveling there, staying there for a few days or sometimes up to a week. You need to be meeting people at restaurants and at like at every opportunity where you can connect to the locals, right? So meeting locals basically give you a lot more insight about what it feels like being on the ground. It also tells you a lot more about the history of the area, the past performances, if anybody has invested in the region or they have got relatives who have invested, what locals think about that particular region as a whole, and then what their viewpoints are about the suburbs, because how locals perceive the suburbs are very, very important. And that also drives a bit of a capital growth, right? So how locals perceive and what their experiences have been could be very different when you start talking to real estate agents or property managers who could have vested interest in real estate there. Because with real estate agents and property managers, if the market, there is a movement in the market, that is how they make money. It's very different for us. We make money regardless because we are moving between markets very often, right? But for our real estate agents and property managers, they are local operators, right? So the market has to move in order for them to be doing it successful. So if you ask a real estate agent, because who is working for the seller and against you as a buyer, if you ask them that is this the right market to invest, how the market is, you would never see them unless they are a close friend of you or you have got some relationship built. They would never say the market is cool or dead or you should not be investing in, because they've got a vested interest in that. And similar with property manager, because if you buy property as an investment for through real estate agent, you would be looking for a property manager. In order to grow their rental role, they would not be providing you the right advices. So speaking to probably 5, 10, 15, or whoever, however number of people you can talk on the ground is going to be very, very important. And then you should also be like, say, for example, you have selected 5, 7 suburbs based on data metrics. Now, I want you to be going through those suburbs, drive through them in day and night, and understand what it feels like. Stand on the streets and see what it feels like. Does it feel safe? Because if you are, and I'll tell you based on my local personal experience, right? When in 2021, when I was investing, just because I couldn't travel to Perth, and when I bought my 3 properties in 3 months in Perth in mid of 2021, there was a suburb called Thornley where the median price of Thornley was 395, and there was another suburb in Canningvale where the median price was 575. So if you're looking at data, because due to affordability, there are a lot more people looking in Thornley than Canningvale. Supply and demand metrics, supply especially, sorry, not supply, but demand especially would be always inclined towards this suburb, which is cheaper. But it is cheap for a reason. So for anyone who is just looking at data, they are missing out on a very critical aspect. They don't know why it is cheap. Just sitting next to each other, and one suburb is 1.5 times. But when you go on the ground and drive through these suburbs, you can unlock why it is. And now Thornley might have gone to $700,000, but then Kenningvale has crossed $1 million mark. The difference is still stayed, right? So very crucial for you to be understanding the how does it feel like being on the ground there, what this suburb looks like in day and night, and how locals perceive that suburb. You can do that by going to shopping centers, talking to strangers, and yeah, asking the right question will get you the right answers. And then third one is establishing connections with the real estate agents and property managers. So establishing connections with real estate agents are important, because if you plan to buy there, they at least know your name, because you would be segregating yourself from most of the people who are just doing research and randomly ringing them. Because if a market is warm or hot, you couldn't believe how many phone calls they receive. But if you met them on the ground, had got them for a coffee, they will remember you, and eventually that will start resulting in some favorable business for you, right? Or getting the right asset through them. They might prioritize you. And then property manager also meet multiple property managers, interview them, what their processes are like, and then find the best one whom you like based on their processes and not just their fee, on how they operate, what kind of workload do they operate under, how many properties are basically done by a single property manager, and a few more questions. If you and that is very crucial for you. And like if you are not traveling again for the property, these property managers can be your eyes and ear on the ground. They can, you cannot replicate their knowledge because they are working there on the ground for maybe 5, 10, 15, 20 years, right? So regardless of how much time you spend there, 2 weeks, 4 weeks, you would not be able to establish that level of local knowledge what they have got. And that tapping into that knowledge is not hard. All you need is a connection and a relationship with them. And it takes time and effort. Okay, so where a buyer's agent can help, right? Again, time and research is one part where you need to be spending time. Many busy professionals don't have time. They are just not buying properties for years and years just because they couldn't find time and they're already too busy. But the market is not waiting for them. The market has doubled, like regardless whether they bought or they don't. So many people have actually missed out just because they were short on time, right? And then also the research, because this may not be their full-time job. They may not be doing it on a daily basis. They, even if they know some of the tools, they are just using some of the basic thresholds, which thresholds might have changed by now. So thresholds 5 years ago have actually, if you're not being on the market on daily basis, you wouldn't know how thresholds are changing. And that threshold, the lower thresholds that you were using earlier, which might be making you miss on multiple good opportunities, right? So yeah, getting an expert help here could help. And then experience and confidence, right? Like say, for example, if you're working with an expert here who is actually working with agents all the time and doing so many deals on weekly, monthly basis, they actually know how to navigate you through complex situations, right? Building and pest issues and a lot more other challenges that you might have seen. might encounter, right? So they, because based on their experience, see, even if they are not as smart as you, because repetition is the mother of skill, they have just done it so many times over and over again, and they've learned from whatever mistakes or corner cases they would have seen, they've learned from it, and you get to leverage on their experiences there. And then again, with experience comes the confidence, right? And then the industrial relationship. So industrial relationship again is very crucial, as I mentioned in the previous slide. In industrial relationship, like, see, sometimes it's not even feasible, or like you, because people are busy. So say for example, if me as a buyer's agent, if I'm traveling to a region, spending a week, spending maybe 3 grand, 5 grand, staying there, meeting real estate agents, having lunches and dinners with them, giving them gifts to establish connection, for me it is worth it because of economy of scale. Because if I like that region, I might end up buying 20 properties, right, for our clients in next 5 years, 5 months. Like there have been markets where we about 50 plus properties. So it's always an economy of scale for us, because if we are buying 20 properties and I'm spending 5 grand, what I'm spending per property? Nothing, right? But if somebody is doing just to buy their own property, they are not only leaving their time and desk and job and family, but they are also spending 5 grand saved with whatever money the buyer is charging. It may not be worth it. And then also understand these industrial relationship, when you are only doing a single transaction, and when an agent knows that he's only going to be interacting with you once, because you might just end up buying 1 or 2 properties at max, they would favor a buyer's agent, because they know with a buyer's agent they might be doing 10 20 transaction if this is their area of choice, right? So industrial relationship, that is where you leverage. So even for us, like when we are entering into a new market, for first or two deals, it is a bit of a struggle. Like though we know how to do it over and over again, because we are just moving between markets, but industrial relationship cannot be there. There's no shortcut. You have to be doing them transactions to be building the trust, and then you start basically getting bargains. Because we have had experiences in the past where very reputed agents, just because of the ease of transaction with us, they were giving us property at a very good price in comparison to what they could have sold in market. Real estate agent might not be bothering for the last $5 to $10,000. If we are giving them ease of transaction, they don't have to deal with the buyer at all. They don't have to justify or prove any answers, because in a 700K market, like it doesn't really impact for them from 700 to 705 to 710, right? What they want is an ease of transaction for them. So if you are able to build that relationship and trust with them, then it is again very important. So that is where buyer's agent can help, where because it is coming through a buyer's agent, they know that most of the buyer's agents today are vetting their client. They know that they are taking clients on board only who are finance approved. They know, so a lot of vetting has already been done. So they trust buyer's agents a lot more uh, for their offers in comparison to random buyer ringing them, giving them a verbal offer, and then they reach out to the vendor get it verbally accepted, and when it gets to the contract signing stage, buyer doesn't respond. It's a very bad on them. That's what there's like, I've heard this so many times over and over again from so many agents in different locations. So industrial relationships actually give a very good advantage there. So more ways a buyer's agent can help, right? Basically a full journey support, so they can actually start not just from property, they can start with your goals, they can then help you formulate a strategy to reach that goal, and then they can actually execute it for you. And then, as I mentioned earlier, saving time, you only need to be spending time in saying yes and no to a property and provide your feedback and responses. That's it. They do everything end to end for you, right? And then avoiding mistakes, yeah, that is, I think, one of the biggest ones, because in real estate, the biggest problem is the mistakes are very, very costly, not in just in terms of time, money, right? It's in terms of time. So losing 5 years and not making money could actually be a whole game changer if you would have invested correctly, because this property, for property number one, if invested correctly, could have been a stepping stone to property number two in 3 or 6 months or 12 months time, where it could have been combined, be a stepping stone for three, where you could have built a portfolio of 5, 7, 10 properties, uh, and as opposed to buying an apartment in the wrong locations, and then you are basically sitting with an asset with little to no growth, also hampering your whole journey. So real estate, the regardless of what you buy today, regardless whether through a buyer's agent or through yourself, you wouldn't know whether you have done it right and wrong tomorrow. You would be spending 3 to 5 years, or and sometimes it could be smaller, because we are sometimes targeting short-term capital growth where we are making money in 6 to 12 months. So sometimes you get to know that faster that you've done it correctly, but usually it takes a lot longer for you to understand whether it was the right investment or not. right? And then research and negotiations, they handle the data, they do the research, they get on the ground, they do the deals for you, they do the negotiations, they do everything that is required to safeguard your interest. And then again, as I've discussed, like access to agents and network of agents, and then everyone else needed in this transaction. If you need a financial planner, they might have worked with 10 financial planners and found the best one which works. We keep working on real conveyancers, solicitors, a lot of them, and then again, based on our experiences, we might be choosing the best one to work with. Okay, so this is, I think, very crucial for anyone to understand, right? This is where 99% investors go wrong, and that is the reason why they don't get past two, three properties. The reason is because everyone is trying to find an answer to where, and they just like, as soon as they know where to buy, they just go and buy there without understanding, without understanding what their goals or objectives are. And the biggest problem is here with this model is that your where could be very, very different from my where, because I could be at a very different uh, uh, at a very different stage of my portfolio building journey. My goals could be very different than you. I might have a different cash flow appetite than you. So understanding just where is just half of the story. So I always suggest people that, and do three properties is very easy, right? Like someone who's on a decent income, they can just randomly acquire assets based on opinions of the people, news articles, and they can just buy two, three properties. But property doesn't mean financial freedom unless you do it strategically. Because in 3 to 5, 7 years, you start realizing that these properties are probably interfering with each other and not leading us to any specific uh, path, right? So understanding the where is super crucial. No, sorry, understanding the where is crucial, but then understanding the why behind this investment and your goals is even super crucial, right? So when we are talking property, property is just a way for you to achieve a goal. So you're just using property as a vehicle, right? For some people, it could be stocks or crypto, right? You're using property to achieve a goal or an outcome. So always start with a goal or outcome in mind, and then formulate a strategy to reach that goal or outcome, right? So for any individual, unless there are major life-changing circumstances, goal or strategy should never change. So when you formulated your goal, you formulated a strategy to reach your goal so that each of your asset acquisition is taking you closer to your goal. Your goals and strategy should remain consistent. And then whenever your strategy is finalized, now you are ready to make a purchase, then you want to find the regions where that strategy would work best today. And then in 12 months time, you're ready for your next purchase. You want to find again the region where that strategy that you've established earlier, again, best at that point in time. So a region would keep changing, which would keep changing the suburbs, and then your property keeps changing. So when you are only focusing on the location, you are missing out on a critical aspect, a very critical aspect, which would not let you go to more than two, three, four, five properties. Okay. So we will move on. Just give me a second. I'll see. Okay. Okay, so we'll just go through two of the client examples just in interest of time. I wouldn't be spending too much time here. You can go on our website and find these. This is one of our clients who was referred by another client of mine, and that client has referred 4 to 5 clients of friend of his to us. He was one of them. Works in Macquarie Bank, an IT professional. Wife is, I think, not working. He is just working as a contractor using a company structure. His loan structure was very complex. He's worked with a few brokers, and then he was finally able to get a mortgage. So this guy had a principal place of residence in Doonside, has never invested in real estate. So he wanted to do that. We ended up buying, after introduction, we ended up buying first property for him in October 2023. Purchase price was $493,000. Current value sitting around 770 for this. So it is around 52% capital growth in 25 months. Rental appraisal at the time when we bought it is 600 per week. Today it should be easily touching or crossing $700,000. We have not followed up with the client what the current rentals are. And the rental yield at the time of purchase was 6.3. This was bought, and this is 5, 6 years old property on a 600-meter land. So it's by no means it's an inferior asset. This property was bought, and again, I'm disclosing the location where here, but understand this where, as we have just gone past its peak, and I don't recommend, we are out of this market more than 12 months now. So this property was bought in Townsville in a suburb called Bushland Beach, which is one of the premium high owner occupancy beachside suburb. And then we ended up buying second property for him in this was in Perth, in 19 kilometers south of Perth in Huntingdale. This was the time, if you remember, if any one of you remember, this was the time when Perth was the hottest market in the country. So I knew this agent very, very well. I sat in his office and I knew all members of his family very, very well. So as soon as he went to the property and was about to sign a selling agency agreement, he rang me that I've got a property in the market. If I put it in the market, it will easily attract in offers in high 500s, because this was the time when each property, again, because of the herd mentality, was getting 25 to 30 offers. And so he mentioned when the owner is the last he'll accept is 530. I know because the owner is not informed about the market movement. He trusts me, and then he told me that 530 will get you a deal for your buyer. And then we negotiated further and grabbed it at $515,000. Nobody else knew about this deal. Current value sitting around $779,000, around 51% capital growth in 22 months. The rental appraisal at the time when we secured was 650 for this, and rental yield at the time of our securing was around 6.6%. Currently, like if you factor in today's rentals, the yield on purchase is going to be much more higher. Then the third property was bought in May 2024. Purchase price was $530,000. This was again in Townsville, in a suburb, very central location suburb called Curwen. And we got again this property off market through a Ray White agent who just used to work and give us the first opportunity. So he just started liking us so much that, and we met him multiple times, like in our trips to Townsville. And this guy just flick any property that is coming his way to us, and if we didn't buy it and if it is not suitable for our clients, then it used to go out to the market, their email database and everything everywhere else. So this property was secured at 530. 710 was the current value, 34% capital growth in 18 months. Rental appraisal again was 640 at the time of the purchase. Then fourth property was bought in Perth again. This was through an agent from Professionals. Ellison was the name. And then this property was again an off-market purchase in a beachside suburb in north of Perth, which is, I think, 35 kilometers north. And it's a very beautiful suburb. And this is in Butler. We bought it for 610 and the current value is sitting at 770. So 26% capital growth in 17 months. Now, if you start looking at how this has performed versus how this has performed, we are now crossing the peak. Like we were probably a little bit past peak. And 6 months after this, we stopped investing in Perth, right? So now if you invest in Perth at 770 and expect you to be making $1 million, yeah, man, good luck with that. Okay, so the combined equity that this guy has made after buying these four properties with us until now is around $881,000, which is much more than any individual purchase here. Again, Ellen, 25-year-old YouTuber. This guy again lives with parents, does like he is a social media influencer, has got I think more than 50,000 followers on Instagram. So we bought first property for him. This was a very, very unique purchase. Its value was in 600s. It was initially listed 18-month-old home. From first floor, you can see the beach. Sorry, not the beach, but the ocean and the magnetic island. Only 18 months old home. It was initially listed in 600s. Then they couldn't sell it because the retaining wall at the back was not council approved. So he was willing to give us around 550 mark. Then we kept negotiating. And then also in the contract, while securing it at 550, like it took us a few months. And then for a settlement of this one, we probably spent 4 months because we got a special condition added where the retaining wall will be approved by the seller at their cost. And we were in the contract just waiting for that approval 4 months. But the outcome has really been fantastic. Okay, so and then the current value is sitting around 762, 48% capital growth in 23 months. Rental appraisal 680 at the time when we bought it. At the moment, we have not tracked with the client. And then the second property was bought in Perth in a very good south suburb. And then third property was bought for him. And then the fourth one was bought uh, in not 2 months ago now. We are in October now, right? So about 2 months ago. And now we are already discussing, he has already got $185,000 of more equity that he can tap into, and he want to buy his fifth property through us. Again, combined, he has made around $570,000 equity in all these four purchases. So we have got to a point now where we are leaving it to question and answers. So we'll first go through the question and answers in the chat.
Yeah.
And after that,
So Rohit, you want me to read it, or you can start reading from the AM, or I can read
Okay,
it as
no
well.
worries. I will start reading it now. No
Mhm.
worries. Okay, so the first question, let me just grab some water. Yeah. Okay, how can you buy more properties when your borrowing power depletes? Is it under trust or something else? Yes, there are always ways. So you need to be working, you need to be taking a financial advice. I cannot give you, as I mentioned, we mentioned earlier, I cannot give you an advice whether trust is right for you or not. But yeah, using trust, you can expand your borrowing capacity. That's what I basically know. But I cannot advise any more on that, because you need a financial license in order to do that. Okay, the data you showed for selecting the suburb, where do you source that from? That important for analysis. How recent is it and how accurate? Okay, so there are multiple data sources, and the strange part is that if you are only subscribing to a single data platform, you could be misled. So I suggest always subscribing to multiple platforms, and it may not be cost effective. I understand that, but what you are putting on stake is your decision there, investing decision. So which is a lot more money than what you would be spending on them. So yeah, there are multiple sources. If I have to tell you the sources, we use Stash Property, DSR data, hashtag, Price Finder, Core Logic, RP data, Archistar, and SQM Research. Right. So these are the tools that you can use. Again, a combination of them. Some are good at something, the others are good at something else. So we are relying on some data elements on some platform. For something, we go to another platform, and for due diligence, we use something else. So recently, these datas are usually, for many of these tools, are getting updated once a month. But again, it is very specific to their how soon they are getting the feed, right? So if you are looking at avms, avms usually are like always lagging 3 to 4 months. The reason is because automated valuation models of price finder or core logic that you see, or that you basically get an automated or desktop valuation from your lender, they usually refer core logic's rp data, which is totality now, by the way. So that is, again, like if you have got experience in machine learning and how it works. So what avm is nothing but automated valuation models, which are nothing but machine learning models. So they're trained with the data, and this data to them of sold properties is coming from the titles office, and title office get that data when the property settles. So say for example, if you are sitting now today in mid of October, you sign a deal today and you're settling in mid of December, then mid of December the data will be available with them, a titles office, and then it might take another 30, 40, 50 days, because it depends upon schedule of the feeds, and then it get fed to these platforms, and then they use that data to train them model to give the avm. So in a stagnant market, it may not be too much relevant, because you are probably looking at a bit of an accuracy there. But if the market is moving 20,000 per month, you might be looking at 60,000 odd data. And that is very, very common theme if you are competing in hot markets. See, if your intention is to be building short-term capital growth because you want to be building a portfolio, that is the right strategy for you. You need to be getting into hot markets. But the downside of hot markets is they will be moving a lot faster than you can move. So you need to be prepared to act fast. And also the data, like if you want RP data to be aligning with what you are paying, it will mostly not happen. Hope I've answered your questions. Yeah. How quick the market moves. Picking a suburb to purchasing there, how far the data has already moved, and obviously the price. Believe it's not like stocks and crypto where it's too volatile. Yes, it's not like crypto, but some markets we have seen moving like by a couple of percent each month, like which is very unbelievable for us. But we have seen that happening. We have secured properties. Again, I won't disclose the locations, but I'll just disclose some numbers. We have bought property for a client at 552, exact 552, very good property, and in those markets. And this was, I think, settled in May or June, and now we are in October, and all comparable properties are sitting around 680 to 690, right? Like we are probably talking 4 months, 5 months, and like in terms of percentage, what kind of growth they have got. So markets can move very, very fast. Again, depends upon a lot of supply and demand pressures. So if there is not enough supply being created, but there is a lot of demand that is there, and it could be demand just from investors, right? So again, you need to be understanding why, and that's another downside of just looking at dsr, right, or any other data platform or hashtag, for example, that you look at. Because if you're just looking at the supply demand side, like demand could be inflated, like all of us in the call, if I say X is the location, 100 people start buying there, and the location is small enough or the suburb is small enough, there is a massive inflated demand in it that continues 3 months. You would see a lot of price movement. But is that sustainable? So very, very important for you to move, because price movement just like this because of an inflated temporary demand may not be the right investing strategy for you. Hope I've answered your question. Okay, so then general question, what price ranges are you buying property lately, just to see where I stand in my savings? Okay, price points. Okay, so mostly are, 600 has become the new 400 now. So most of the purchases that we are doing are between 600 to $1 million. Again, depending upon where you stand with respect to your cash flow appetite, where you are in your investing journey, what your family circumstances look like, and a few more aspects. So that will determine which location, which will then determine which prices. Perfect, guys. So I think we can open the floor. Thanks, Ajish, for the thumbs up. So anyone has got any questions, more than happy to answer. You can just unmute yourself or throw a question in the chat, and I'm happy to answer. Anyone wants to ask anything? Any other specific question?